Welcome to Edgemoor Investment Advisors' video presentation of our 2024 Market Review and Outlook. I am Gay Truscott, and I'm joined today by my colleague Steve LaRosa. Our agenda for today's presentation mirrors the topics discussed in our quarterly newsletter, which can be found on our website, www.edgemoorinv.com. Our agenda today will cover the following topics. 2024, another strong year for equity investors. The Fed slows down as inflation remains sticky. The productivity factor. Fundamentals of the U.S. economy remain strong. Portfolio implications and actions, Edgemoor's outlook, and a review of two securities we are currently buying. Let's get started. 2024 proved to be another strong year for equity investors. The S&P 500 index, the broadest measure of the U.S. stock market, delivered its second consecutive year of 25% plus returns, the first time since 1997 and 1998 that the index notched back-to-back 20% plus gains. As shown in this slide, the S&P 500 returned 2.4% in the fourth quarter and 25% for the full year, an extraordinary gain on top of the 26.3% returned last year. It will probably surprise no one that the communication services and information technology sectors once again drove the gains, with financials and utilities not far behind. The positive momentum was propelled by a combination of strong GDP growth, cooling inflation, and solid corporate earnings. These favorable factors made the U.S. economy the standout among global economies, many of which had to endure slower growth as a trade-off for curbing inflation. The Bloomberg Barclays Aggregate Bond Index did not fare as well, returning just 1.3% for the year, driven down by a 3.1% loss in the fourth quarter alone. The yield on the 10-year Treasury, a key barometer of the bond market, jumped sharply in the fourth quarter, from 3.6% in September to 4.6% in December, sending bond prices plummeting. Remember that bond prices move in the opposite direction of interest rates or yields. Much of the volatility in rates at year-end had to do with the Fed. The Federal Reserve capped off last year's rate easing cycle that began in September with a modest 25 basis point or 0.25% cut to its benchmark federal funds rate in December. This brought the total rate cuts in 2024 to 100 basis points, or a full 1%, to a final range of 4.25 to 4.5%, as shown in this slide. Chairman Powell also signaled in his remarks a cautious stance for 2025, indicating the likelihood for just 2 additional rate cuts this year, down from the 4 cuts expected earlier in the fall. The actual number of rate cuts, if any, for this year remains unclear. Powell's caution stemmed from a number of factors, including still high inflation forecasts, coupled with strong growth and employment expectations for 2025. It appears we may be in a higher than expected long-term rate environment for the near term. Now let's turn to inflation. While inflation has come down significantly since its peak in June of 2022, the absolute level of prices in the U.S. still remains high. As shown in this slide, the Consumer Price Index, or CPI, which is the broadest measure of inflation, was up 2.8% year over year in December, which marked the third monthly increase after several months of steady declines going back to March. Higher prices for food and housing were once again the biggest contributors to the inflation gauge and were only partially offset by declines in energy costs. Housing costs comprise roughly 40% of the CPI index, as shown in this pie chart, and are proving to be the biggest and most difficult obstacle to the Fed reaching its 2% inflation target. Now let's talk about something new, the productivity factor. The U.S. economy has achieved the favorable combination of strong GDP growth, low unemployment, and cooling inflation, due in part to surges in productivity and available labor. Labor productivity, which is a measure of how much output is produced per unit of labor, has risen sharply over the last decade, as shown in this slide. Specifically, between 2022 and 2024, productivity increased at a rate nearly double the annual rate for the prior 10 years. The advances in labor productivity and output have resulted from a confluence of factors, including a surge in new business formations post-COVID, technological advances that boost worker efficiencies, and expansionary U.S. fiscal policies that have targeted major domestic initiatives like semiconductor production. And then, of course, there's AI. Artificial intelligence and its promise to transform everything from healthcare delivery to manufacturing to energy production has the potential to boost economic productivity for many years to come. As we've talked about before, the AI boom is still in its early stages, and while the costs, the timing, and the ultimate outcomes are still not fully known, they certainly look promising. The U.S. economy. The fundamentals of the U.S. economy all remain on solid footing. Specifically, GDP growth has remained strong, growing 3.1% in the third quarter of 2024 and expected to grow another 3% in the fourth quarter. The unemployment rate stood at 4.1% in December, which, while higher than a year ago, remains low by historical standards. Corporate earnings, which are one of the primary drivers of stock market returns, also continue to grow, ticking up 5.8% in the third quarter, and it's expected to grow nearly 12% in the fourth. And finally, consumer spending has remained remarkably resilient, even in the face of higher inflation. It was propelled in the fourth quarter by a record $1 trillion in holiday spending, according to the National Retail Federation. And remember, consumer spending accounts for nearly 2/3 of U.S. economic activity. What's next? With the November presidential election behind us, investors are eagerly waiting to see what economic policies will get implemented by the new administration. Most are expecting an easing of regulations, a tightening of immigration policies, the extension of tax cuts, and the imposition of tariffs on a wide array of goods and services. We'll see what happens. The risks we are watching include a resurgence of inflation, which is a possible risk of both tighter immigration policies and stiffer tariffs on our trading partners, and could increase the risk of recession. We are also watching for a possible market correction of 10% or more, which is seen by some as statistically overdue. The ongoing conflicts in the Middle East and Ukraine are of continuing global concern, while the economic slowdown in China has created uncertainty for companies and consumers worldwide. And finally, a possible slowdown in global trade represents a key economic risk worldwide. So stay tuned. Now I will turn it over to my colleague Steve LaRosa to talk about the portfolio implications and actions, our outlook for 2025, and to review 2 securities we are currently buying for client accounts.
Thank you, Gay. We still remain cautiously optimistic about U.S. stocks despite lofty current valuations. The forward price-to-earnings ratio for the S&P 500 is currently 21.7 times, higher than the 5-year average of 19 times. But not all sectors or companies carry such high valuations, and we have been able to find pockets of opportunity in areas like energy, healthcare, and financials at substantially lower valuations. We also expect to see a further broadening of market performance beyond just the tech giants that have dominated market returns for the last several years. Specifically, we have already seen a positive shift in investor sentiment towards sectors previously left behind, including utilities, telecom, and real estate, all segments we own. Looking ahead, the risk-return trade-off of bonds has become more attractive. Higher starting yields and lower future rates should combine for attractive long-term returns and a valuable ballast to equity exposure in balanced portfolios. Overall, we maintain a positive long-term outlook for the U.S. economy and markets, but it remains to be seen whether momentum or valuation will dictate investment returns in 2025. History tells us that momentum is a very powerful force that can propel markets higher for several quarters or even years. If the U.S. economy remains in a productivity boom driven by AI and a strong labor market, which many expect, then positive market momentum could prevail through 2025. On the other hand, valuations are always an important market determinant, and at current levels they can be considered stretched. As long as growth in earnings remains solid, particularly in technology-related sectors, then higher equity valuations may be justified. Overall, we consider the current U.S. economy to be on solid footing and the near-term risk for recession to be low. Absent an economic or policy shock, equity markets should continue to generate positive returns into 2025. We believe our patient, disciplined approach to individual security selection offers our clients strong long-term return potential in a cost-effective and tax-efficient manner. Even though markets can be volatile quarter to quarter and year to year, we emphasize to our clients the importance of sticking to a long-term investment plan focused on their specific goals and objectives. Now I am going to present our analysis of 2 stocks we own and are currently buying. The first is Amazon.com, and the second is Johnson Controls International. Amazon is the largest e-commerce company in the world by both market capitalization and revenue. The company also has numerous service offerings, including fulfillment, advertising, publishing, gaming, and cloud computing via Amazon Web Services, or AWS. The company's Prime membership subscription is a key differentiator in online retail services, as it offers free shipping for members and exclusive media content, including TV and movie streaming, music, and Audible books. Amazon is also the largest global provider by market share of cloud-based infrastructure services through its AWS platform, serving 31% of the market, which is well ahead of second-place Microsoft Azure's 20%. In 2020, the COVID-19 pandemic ignited an explosion of demand for online retail services and cloud-based business operations. This demand persisted as retail customers became accustomed to the ease and efficiency of ordering goods online, and many office employees have never returned to the office full-time. Amazon enjoys a wide economic moat due to its many competitive advantages, including a strong network effect, cost advantages, scalability, and brand loyalty. In addition, Amazon's growth trajectory remains promising. AWS and online advertising should be the main growth drivers going forward, in addition to continuing growth in e-commerce, which should accelerate earnings growth due to the high profit margins of these businesses. Shares of Amazon returned 44% in 2024, vastly outperforming the industry and the overall market. We believe Amazon's dominant position across its various markets, compelling growth prospects, and current valuation metrics provide a long runway for positive investor returns. Now I'd like to discuss Johnson Controls. Johnson Controls International is a global industrial conglomerate that offers intelligent building systems, efficient energy solutions, integrated infrastructure, and transportation systems to mainly commercial building customers. The company began in 1885 as the inventor of the first electric thermostat, and today is an innovator of products ranging from thermal detection devices to security systems and integrated energy control systems. Johnson Controls has gone through a transformation over the past several years in order to streamline its business and focus on commercial buildings technologies and engineering solutions, which has resulted in a more simplified, higher growth company with a stronger margin profile. Johnson Controls' order growth has been steadily increasing, and the company ended the most recent quarter with a record backlog of $13.1 billion. Increasing demand for energy-efficient building solutions, specifically in data centers, has been a key growth driver. Management has also shown itself to be shareholder-friendly, targeting 100% of free cash flow to be returned to shareholders through dividends and share repurchases over the long term. Overall, we believe JCI is a core industrial holding that will continue to benefit from secular growth trends in more intelligent building solutions and integrated infrastructure in their key government, healthcare, and higher education end markets. That concludes our fourth quarter 2024 presentation. We hope that you found it helpful and informative. Please feel free to reach out to us with any questions or comments. Thank you for tuning in, and we hope to see you back next quarter.